If you want to know where the next major bailout will have to be, look at insurance companies. Look at the annuity powerhouses. When I say that's where the bodies are buried, we're talking about mass graves.
Welcome back to part 2 of the private credit series. In part 1, we covered the explosive growth of private credit between 2008 and 2024, and then the sudden shift in consumer spending and consumer confidence in 2025 that blew up First Brands Group and Tricolor last year. That put the spotlight on the private credit industry, which then followed by liquidity events.
How do you view the fact that 7.9% of your fund holders, or those representing 7.9%, wanted their money back?
To rushing investors wanting to pull out money from private credit. But there is a massive hidden player in this saga that hardly anyone talks about. One that could turn these cracks into something much bigger. Life insurance companies and annuity providers. They've quietly become one of the single largest holders of private credit in the world. And today we'll discuss exactly how deep their exposure is and some clear, well-known hidden risk, including some offshore moves that hide risk further, and how their problem could quietly amplify into a full-blown credit crisis that could hit everyday's retirement savings.
Because insurance companies don't have the equivalent of depositors, the captive asset portfolios at insurance companies have been prime targets for private equity and private credit. Right? So this is again where these groups get to dump their trash. And the intent of these insurance companies is to continue to add to private market holdings. The effort is to smooth long-term returns.
Firstly, let's start with the scale at which insurers have invested in private credit. Look, according to AM, a major credit rating agency, US Life and US Annuity Insurers held an estimated $1.8 trillion in private credit at the end of last year, 2025. Looking at Barclays research showed private credit investments by life insurance jumped by 21% in 2025 alone. An additional $83 billion, more than double the growth rate of overall asset. Those holdings in private credit now make up about 8% of the life insurance, $6 trillion total asset base, up from 7% a year before. Other research agencies estimate even higher numbers. Moody's data cited by IMF puts US insurers' overall exposure to private credit instrument at over 35% of their balance sheet. On average, 35%. And it's especially true for insurers owned by big private equity shops. Think of Apollo's Athena or KKR's Global Atlantic. Look, on top of the direct exposure to private credit, on top of these direct exposure, insurers also held or hold $276 billion in CLO, collateralized loan obligations. CLO is basically a big basket filled with hundreds of individual corporate loans. Remember CDOs, in 2008? So CLOs are equivalent but focuses on corporate loan obligations, so basket of these loans. Now, according to NAIC data as of year-end 2024, life insurers accounted for 82% of the total CLOs. So same big private equity firms, Apollo, KKR, Blackstone, Ares, that are involved in private credit also create and manage these CLOs. So this is on top of their exposure to private credit. Bottom line, insurers aren't just dipping their toes in private credit. They are one of the biggest buyers keeping the entire ecosystem afloat of private credit. Now, these deals between the companies and the big private equity firms are completely private. No one gets to see the details, including banks, so everything stays hidden. So right now, truly nobody knows how bad the situation truly is. This private credit exposure could amplify to a full-blown credit crisis. And this is when it gets even more dangerous due to insurers' involvement. A credit crisis isn't just one big bang. It's when credit suddenly gets tighter across the globe for everyone. The borrowing cost spikes and the real economy feels the squeeze. And it's not going to be a US phenomenon. It'll be felt across the globe.
Insurance companies becoming shadow banks as far back as 2023. This is not a news flash. It just takes time for rot to sort of fester.
You know, I wonder, because one of the things that the insurance companies have avoided is a lot of government regulation because they self-regulate.
Insurers are a key transmission mechanism for money. Let me break it down into two clear ways. This can snowball into something more serious if this happens. Firstly, lack of transparency leads to sudden losses. Like we've seen this already happening. One quarter, the insurers book shows that a loan is 100 cents on the dollar, right? Everything looks fine. Then the next quarter, a company like Tricolor goes under and the same loan suddenly gets written down to zero. Now, because these loans are private, nobody saw it coming. The loss hits the insurance company's safety cushion to stay legally solvent and to meet the requirements from the regulators. The insurance may be forced to quickly sell other investments like stocks or even government bonds at fire sale prices. That's when the trouble spreads. One hidden loss in private credit ends up hurting the rest of the financial market or part of the financial markets. Now, second reason is the hidden leverage and the offshore tricks. When you pay your insurance company's premium or buy an annuity, that money goes to the insurance companies. The insurance companies puts that into private credit funds and CLOs. Those funds then lend that money to middle-sized companies, right? That part sounds normal. Everything seems fine in that scenario. But here is when things get risky. Insurance companies goes further and add hidden leverage to grow returns in two separate ways. First, by repo financing. They temporarily pledge some of the bonds they already own to banks, so US Treasuries. They go out and pledge that treasury to a bank. In return, they get cash immediately and they agree to buy the bonds back at a later date at a higher price. Secondly, a similar practice by doing securities lending to earn some additional yield. They lend out their stocks and bonds to other investors like hedge funds. In return, they get cash as collateral. Then they use this cash to invest in more private credit assets. Because of these tricks, the insurance companies can invest far more money than it actually owns. On paper, a normal insurance company looks only modestly leveraged, maybe 2 or 3 times. But when you add up everything, the private credit funds, the joint venture, the loan funded, and the middle market CLOs they own or control, real leverage across the whole chain can reach 9 to 12 times. This means a small loss in the actual loan can get magnified much larger and turn into something much bigger problem. Oh, and I've not even discussed the offshore moves. Many private equity owned insurers use what we call the Bermuda Triangle strategy. They move a large part of their annuity promises and reserves to reinsurance companies in Bermuda or in Cayman Islands. These offshore companies, as you would expect, faced much lighter rules and less oversight. By the end of last year, 2025, US life insurers had shifted more than $1.1 trillion in reserves offshore, more than the double since 2019. About 70% of what went to the reinsurance companies tied to the same private equity firms. This is perfectly legal, but it creates a dangerous blind spot for everyone. Look, this does not mean every insurance company is about to collapse tomorrow. Not at all. Many still have very strong balance sheets. But the warning signs are flashing louder than ever. This $1.8 trillion in direct private credit exposure, along with the hidden leverage that can reach up to 12 times in some structures, along with the surging defaults driven by weaker economy. That's exactly how a problem starts in one corner of the financial system and can quietly turn into a full-blown credit crisis, one that can eventually, unfortunately, can hurt annuities, pension funds, and everyday businesses on Main Street.